Every decade, Wall Street does something strange. It finds someone with extraordinary returns, an unbroken track record, and a way of talking about investing that makes you feel like you are listening to the smartest person in the room. And then, without fail, financial media does what financial media does. It hands them the title, the next Warren Buffett. It has happened in the 1990s. It happened in the 2000s. It happened in the 2010s. And right now, in 2026, it is happening again. Here is what nobody tells you. Every single person who has ever been handed that title has either collapsed under its weight, blown up in ways that made headlines for all the wrong reasons, or is currently attempting a comeback that history gives very poor odds. Every single one. And the investor who is trying to claim that title right now, we will get to them at the end of this video, because their story is the most interesting one of all. This is The Quiet Compounder, bringing you the best tips and tools for reaching financial freedom through stock market investing. 1. Why there can only be one. Before we get to the names and the disasters, we need to understand something fundamental. Something that the financial media, and frankly, most investors, consistently refuse to accept. Warren Buffett is not replicable, not because he is superhuman, not because he had access to information nobody else had, but because of 3 ingredients that cannot be manufactured, cannot be taught, and cannot be transferred to another person. Ingredient number 1, starting age. Warren Buffett bought his first stock at age 11. He filed his first tax return at age 13. By the time he was 30, he had already been compounding money for nearly 2 decades. By the time most investors have their first serious insight about markets, Buffett had already lived through bull markets, bear markets, recessions, wars, and political upheavals, and had learned, with real money on the line, how to stay rational through all of them. You cannot manufacture 20 years of real-world investing experience. There is no shortcut. Ingredient number 2, compounding runway. Buffett is 93 years old. He has been compounding money for over 80 years. Here is a number that should stop you cold. More than 99% of Warren Buffett's net worth was accumulated after his 65th birthday. Not because he suddenly got smarter at 65, because compounding is exponential. The longer the runway, the more violent the acceleration at the end. No one being crowned the next Buffett at age 45 or 55 has that runway. They are being judged on the first third of a race that only reveals its winner in the final meters. Ingredient number 3, temperament. This is the one that truly cannot be faked. Buffett once said, "Success in investing doesn't correlate with IQ once you're above the level of 125. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing." Every person who has ever been crowned the next Buffett has eventually revealed a crack in their temperament. A moment where the urge to act overpowered the wisdom to wait. A moment where ego dressed itself up as conviction. That is the crack the title falls through. Every time. 2. The 1990s. Bill Miller. Let's start in the 1990s. His name was Bill Miller. And for a while, a long, extraordinary while, he seemed like the real thing. Miller managed the Legg Mason Value Trust Fund. And starting in 1991, he did something that had never been done before in the history of professional fund management. He beat the S&P 500. Not once, not 5 times, not 10 times. 15 consecutive years. From 1991 to 2005, Bill Miller beat the market every single year. 15 years in a row. The financial media lost its mind. The greatest money manager of our time. The next Warren Buffett. The title was handed over with all the ceremony Wall Street could muster. Books were written. Speaking fees exploded. Assets flooded into his fund. At its peak, Legg Mason Value Trust managed over $20 billion. And then came 2008. The financial crisis arrived. And Bill Miller The man who had beaten the market for 15 consecutive years made a series of decisions that can only be described as catastrophic. He loaded up on financial stocks, Bear Stearns, Freddie Mac, AIG. Companies he believed were undervalued, companies the market was pricing for bankruptcy. Miller disagreed with the market, and the market was right. In 2008 alone, the Legg Mason Value Trust lost 55%. The S&P 500 lost 37%. Miller didn't just underperform. He underperformed by nearly 20 percentage points in the single worst year to underperform. The 15-year streak was gone. The assets flooded back out. The crown was quietly retrieved. So what actually happened? Here is the uncomfortable truth that nobody wanted to say at the time. Bill Miller was never beating the market for 15 consecutive years because he had cracked the code. He was partly beating the market because he had constructed a portfolio that was heavily exposed to financial stocks and economically sensitive companies. Exactly the companies that outperform in a long economic expansion. The 1990s and early 2000s were one of the longest economic expansions in American history. Miller wasn't the next Buffett. He was the right investor at the right time in the right economic cycle. And when the cycle turned, 15 years of genius evaporated in 12 months. Lesson number 1. A hot streak is not a system. A long bull market makes everyone look like a genius. The question is not who performs best when conditions are perfect. The question is who survives when they are not. 3. The 2000s. Bill Ackman, round 1. Move forward to the 2000s. A new name emerges. Sharp, aggressive, brilliant, absolutely certain of his own conclusions. His name was Bill Ackman, and his hedge fund, Pershing Square Capital, was delivering the kind of returns that made other fund managers feel slightly ill. His early career was extraordinary. He was a genuine value investor. He identified undervalued businesses, took large concentrated positions, and held them with what looked like Buffett-like conviction. The crown began to hover. And then, 2 decisions. Decision number 1, Valent Pharmaceuticals. Ackman took a massive position in Valent Pharmaceuticals, a company that was growing rapidly by acquiring other pharmaceutical companies and aggressively raising drug prices. Ackman called it one of the best businesses he had ever seen. He invested approximately $4 billion. What followed was an accounting scandal, a congressional investigation, a CEO departure, and a stock price collapse of over 90%. Ackman lost roughly $4 billion on a single position. Decision number 2, Herbalife. Ackman publicly declared Herbalife a pyramid scheme. He bet $1 billion
Herbalife
that the
sheen
stock would
to
go
zero.
He went on television. He held press conferences. He published 300-page research reports. He was absolutely, completely, publicly certain. And then, the stock didn't go to zero. It went up. Ackman eventually closed the position after years of losses estimated at somewhere around $1 billion. The crown fell. Lesson number 2, concentration plus leverage plus ego is not a value investing strategy. Buffett is concentrated, but Buffett is never leveraged to the point where a single position can threaten the entire enterprise. And Buffett, crucially, is never publicly, emotionally, reputationally committed to being right. The moment you need to be right more than you need to be rational, you have stopped being an investor and started being something else entirely. The 2010s. Cathie Wood. The 2010s produced perhaps the most dramatic crowning and the most dramatic fall in the history of the title. Her name was Cathie Wood, and in 2020, she didn't just seem like the next Warren Buffett, she seemed like something beyond that. ARK Invest's flagship fund, the ARK Innovation ETF, returned 152% in 2020. 152% in a single year. while Buffett's Berkshire Hathaway essentially returned nothing. The financial media didn't just hand her the crown, they melted down the old one and built a bigger one. Buffett is finished. Cathie Wood is the investor of our generation. The future belongs to ARK. $50 billion flooded into her funds. Retail investors poured their savings in. She was on every podcast, every magazine cover, every financial news channel, and then 2021 arrived, and then 2022. From its peak in February 2021, the ARK Innovation ETF fell 75%. Let me put that number in context. If you had invested $100,000 at the peak of Cathie Wood's fame, at the moment the financial media was most enthusiastically telling you she was the future, you would have had $25,000 18 months later, 75% gone. Not because her companies were frauds, not because she was dishonest, because she made a fundamental error that every investor must understand. She confused a specific market environment, zero interest rates, unlimited liquidity, a pandemic that supercharged every technology company on earth, with her own genius. When interest rates are zero, money is free, and every speculative asset goes to the moon. A 152% return does not prove you have discovered something nobody else could see. It proves you were positioned correctly for one specific environment. And when that environment ended, when interest rates rose, when the free money disappeared, the strategy that produced 152% produced minus 75%. Same investor, same strategy, two completely different environments. Lesson number 3, a bull market makes geniuses. A bear market reveals investors. Buffett's genius was never proven in his best years. It was proven in his worst ones. In the years where he looked wrong. In the years where technology stocks were making everyone rich and Berkshire was going nowhere. His returns in those years were what separated him, not the good years. The years where he had the temperament to look stupid and stay true to the process anyway. 5. The 2020s, Bill Ackman, round 2. And now we arrive at 2026. Remember Bill Ackman? The man from Section 3? The Valiant disaster? The Herbalife humiliation? He is back. And this time, he is not just trying to deliver great returns. He is trying to become Warren Buffett. Structurally, architecturally, by design. Ackman has announced his intention to turn Howard Hughes Holdings into a modern-day Berkshire Hathaway. He has followed the Berkshire blueprint, acquiring an insurance company to generate the float that Buffett used to build his empire. And in April 2026, he made his most audacious move yet. A $64 billion bid to acquire Universal Music Group, the world's largest music company, representing artists whose catalogs will generate royalties for the next 100 years. It is, on paper, the kind of move Buffett would make. A dominant business, durable cash flows, a moat that almost cannot be breached. And yet, here is the question history forces us to ask. Is Bill Ackman investing in a strategy, or is he investing in a story? Because there is a version of this where Ackman has genuinely learned, genuinely evolved, and is building something that will compound for decades. And there is another version where a brilliant, ambitious, ego-driven investor has looked at Warren Buffett's life's work and decided he can replicate it in 10 years by following the structural template without possessing the one ingredient the template cannot transfer: the temperament. We do not know yet which version this is. History will decide. But here is what we do know. Every time before, when the media handed someone the crown, when the returns looked extraordinary, when the story was compelling, the ending was the same. Not always immediately, not always dramatically, but eventually, without exception, the gap between the story and the strategy became impossible to ignore. So, what did we actually learn from this decade-by-decade autopsy? Bill Miller taught us that a hot streak is not a system. The right conditions can make anyone look like a genius for 15 years. The question is, what happens when the conditions change? Bill Ackman in round 1 taught us that concentration plus leverage plus ego is not a value investing strategy. The moment you need to be right more than you need to be rational, you have already lost. Cathie taught us that a bull market makes geniuses and a bear market reveals investors. Never confuse a favorable environment with a replicable edge. And Bill Ackman in round 2 is teaching us something in real time, that the most dangerous investment thesis is the one that sounds exactly right, at exactly the right moment, for exactly the right reasons. But here is the final thing, the thing Warren Buffett himself has been saying for decades that almost nobody has chosen to hear. He has never wanted a successor. He has never wanted a clone. He has, in fact, repeatedly said that the best thing most investors can do is buy a low-cost index fund and get out of their own way. The next Warren Buffett is not going to be found on a magazine cover or a financial news channel or a hedge fund press release. The next Warren Buffett, if they exist, will be someone nobody has heard of.